Okay, I don't plan to talk about the quiz. The usual procedure will apply. The usual procedure, for those of you who haven't been in my corporate finance class, is as follows. I will grade the exams as soon as I can. Might be sooner than you want it back, but you will get it back sooner because I don't want it. Okay? So sometime tomorrow morning, you will get an email from me saying the quizzes are done. Come and get them. The quizzes will be outside of the finance department face down. That's why I made you write your names in the back in alphabetical order. Okay? You know where your name is in the alphabet. Don't browse. Okay? Don't tell me you forgot where your name just fell in the alphabet. Just go to your quiz, take it, get out of there. Okay? Please don't get the quizzes out of order because that's going to create chaos for the people who come after you. So if you do not want your quiz to be left out there because you work, you don't plan to come until next Monday, let me know as soon as you can, like right after class today, so I can set the quiz aside and you can pick it up next Monday. Okay? History has told me that about 15 of you will never pick up your quizzes ever. Okay? That quiz will sit out there until I put the corporate finance quizzes out, which will be next Tuesday, and that's going to be real chaos with 425 quizzes coming out this. I'll take your quizzes in next Tuesday if you haven't picked them up, and they will be in my office. And if you want them from that point on, you have to come in and get them from me. It's not like there's a penalty involved other than coming into my office. Right? So that's about it. Right? The solutions will go up tomorrow when I send you the email saying the quizzes are done. I also send you the solutions to the quiz. Okay? Any questions? You don't want to know what the correct debt ratio is, right? Or the right return on capital? Good. I don't want to talk about it. Okay? Anyway. Let's finish off our discussion of growth rates. We talked about 3 ways of estimating growth, and we talked about the first 2 in the last class. We talked about historical growth. And the bottom line there is, sometimes estimating historical growth is difficult to do, negative earnings to positive earnings. And even when you can estimate historical growth, it's not that useful. It doesn't hold on. In fact, one of the most famous studies of earnings growth was done by a guy called I.M.D. Little. He's a Britisher who came out here who did his PhD. And what he did in the early 60s, he did a study where he looked at earnings growth at U.S. companies between 1951 and 55 and 56 and 60. So basically he asked a very simple question. He said, if I know the growth rate in the first 5 years, how useful is that in predicting the growth rate in the next 5? Right? It's a fairly straightforward question. So he did a statistical test. You get the growth rate in the first 5 years, growth rate in the second. He computed the correlation between the growth rates across companies. I'll give you the title of his PhD thesis, and you can pretty much guess what kind of correlation he found. The title of his thesis was Higgledy-Piggledy Growth. Guess what correlation he found between growth rates in the first 5 years and growth rates in the next 5 years? 0. Which is actually the least useful correlation you can find. I mean, very high positive, very high negative are both useful, right? Very high positive correlation would have told you what? That if a company comes in with high growth, it's likely to have high growth in the future. Very high negative correlation will tell you company with high growth rate will have low growth in the future. This is your worst case scenario. This basically tells you that growth in the last 5 years is useless. And think of how much time and energy we spend thinking about what did it grow at, how fast did it grow in the last 5 years. We then talked about analyst estimates of growth. Again, pretty depressing. Once you get past the 1 quarter ahead forecast, analyst estimates very quickly start to lose that informational value. They're not that much better than time series models. So we're kind of stuck, right? So today I want to talk about the third way of estimating growth, which is to look at what the company does to create growth. Growth is not magic. You and I cannot go around endowing companies with high growth rate just because we like a company. Oh, nice company, I'll give you 15% growth. We don't have that power. Growth has to be earned. For companies to deliver high growth rate, they have to do things that deliver that high growth rate. So to kind of set up the process, I'm going to set up a very simple example. Here's a company. Right now it has $1 billion invested in projects. It's making a 12% return on those projects. So right now 12% of $1 billion is $120 million. Next year they add $100 million in new projects, and they continue to make 12% on those projects. So next year they're going to make $1 billion times 12%. That's the original investment. Plus 100 million times 12%, which gives you total earnings next year of 132 million. So their earnings go from 120 million to 132 million. In terms of growth rates, that's a 10% growth rate, right? Algebraically, I can back into that growth rate by looking at 2 numbers. First, I can look at what proportion of the $1 billion was reinvested back. I mean, in a sense, how much the company is putting back into the business. And second, I'm going to look at how well it's investing that money. The two basic questions that drive growth is how much are you reinvesting, how well are you reinvesting. In this particular case, you can actually calculate the entire change in earnings is coming from the new investments they made and the return they made on those new investments. So if you think about long-term growth you can sustain, it has to come from investing more in the business and investing well when you make those investments. There's another way to grow too, right? Can you grow without reinvesting? What's the other way you can deliver growth? Can you make your existing assets more efficient? Sure, right? That's called efficiency growth. Efficiency growth comes about when I take this 12% I'm making on my project and make 13% instead of 14%. Which is more long-term, efficiency growth or new investment growth? What's the problem with efficiency growth? Why is it constrained? So next year you become more efficient, you deliver growth, right? Then you get a little more efficient. But at some point in time, you're going to hit a ceiling. I mean, mathematically, your margins can't exceed 100%, right? So what are you going to do after that? So here's the big difference between the two growth rates. New investment growth is sustainable growth. It's called, it's forever growth. You can keep doing this as long as you can maintain those numbers. But efficiency growth is constrained. Once you hit that ceiling, you're done. Yep.
Did the acquisitions count as
new investments? They're new investments. The question, though, is can you deliver that good return? Remember, it's a combination of two things that allow you to deliver growth, right? Reinvesting more is easy. Anybody can reinvest more. It's whether you can reinvest well while you're reinvesting more that's going to deliver the growth. In fact, I'll tell you, most companies fall into one or two categories. They either reinvest very little and reinvest well. So the reinvestment is a small number, but they reinvest well. Or they reinvest a huge amount and reinvest badly. It's very difficult to pull off both those tricks at the same time, to reinvest a lot and to reinvest well at the same time. So when you think about deconstructing growth, the first question you're going to ask is, how much is this company reinvesting? How well is it reinvesting? The second question you're going to ask is there potential in the short term for efficiency growth? So here's what I'm going to do. I'm going to take 5 different ways of thinking about growth, starting with earnings per share, moving to net income, moving to operating income. And progressively, we'll start hitting more and more problems as we go down the pike. But let's start with each of these measures. With each measure, I'm going to define reinvestment and return on investment. You're saying, isn't it going to be the same for every measure? Not necessarily. When I'm talking about equity earnings, the way I measure reinvestment and return on investment is going to be very different than if I'm talking about operating earnings. Let's start with the simplest measure of growth in earnings per share. When you think about growth in earnings per share, the way I'm going to define how much you reinvest is with a retention ratio. I don't know whether if you remember your dividend policy from corporate finance. One of the ways we measure how much a company pays in dividends is by looking at the payout ratio. The payout ratio measures the percentage of net income that gets paid out as dividends, 30%, 40%, 50%. The typical U.S. company pays out about 35% of its earnings as dividends. The retention ratio is 1 minus the payout ratio. If you pay 35% as dividends, 65% gets retained. So if you're thinking in terms of dividends and earnings per share, the way you define reinvestment is in terms of how much of my net income do I reinvest back in the business through the retention ratio. The retention ratio cannot be greater than 100%, right? So remember that cap. That's going to play a role here. When I think about return on investment, but I'm thinking in terms of equity earnings, the way I'm going to measure return on investment is in terms of return on equity, because I'm thinking of equity earnings. So I'm going to measure how much you reinvest with the retention ratio, how well you reinvest with the return on equity. The combination, the product of those two numbers, will give me my growth in earnings per share. This is not a theory. Algebraically, it's going to be true that your growth in earnings per share is a product of your retention ratio times the return on equity. Now here's a sobering thought. We said the retention ratio cannot be greater than 100%, right? So looking at the equation, you already get a ceiling on long-term growth for a company. If your return on equity is 8%, guess what? In the long term, your growth rate in earnings per share cannot exceed 8%. So when you see companies with 8% earnings per share telling you that they're going to grow earnings at 35% a year for the next 5 years, the response has to be pigs can't fly. If you have an 8% return on equity, don't tell me you're going to be able to deliver 35% growth rates for the next 5 years, because you're going to hit that ceiling very quickly. So retention ratio times return on equity is the growth in earnings per share. Let me take an example. Took Wells Fargo. Right? It's one of the banks that I'm going to value actually is one of the, we'll do a full valuation in a couple of sessions. Banks book equity actually means something, right? Because the capital ratios are based on book equity, assets are marked to market. I'm going to take some numbers that are already ancient numbers for Wells Fargo. I'm going to update these numbers. Towards the end of 2008, Wells Fargo had a return on equity of 17.56%. Pretty impressive, right? 17.56%. They paid out about 54% of their earnings as dividends, which means they retained 45.37% each year. So let's suppose I came to you with those two numbers. Wells Fargo's return on equity is 17.56%. The retention ratio is 45.37%. If they can sustain those numbers, and you can already see, man, that's not going to be possible. Things are changing. But let's assume they could sustain those numbers. The growth rate they're going to be able to deliver is 45.37 times 17.56%, which is about 8%. So if you ask me how quickly will Wells Fargo's earnings per share grow for the next 5 years, assuming those numbers stay fixed, stay stable, they should be able to deliver an 8% growth rate in earnings per share. But this was towards the end of 2008 as the world was shaking under banking, right? In fact, one of the things we know is coming down the pike is that capital ratios for banks are going to increase. They're going to increase because people are concerned that banks have not set aside enough capital to cover their bad loans. So let's take that as a given. Let's assume I told you that looking forward, Wells Fargo is going to be able to sustain its income. Now, it's going to be able to do what it did historically, but it will now be required to have 30% more book equity invested in the business because the capital ratios go up. So I come back to you with the numbers. So let's say the 2000 numbers, you have the earnings per share, the net income from 2008. You have the retention ratio from 2008. I've now changed just one aspect of that. I said, looking forward, they'll earn the same income, but they'll need more capital to deliver the income. What's going to happen to the return equity? First, give me a sense of direction. The return equity used to be 17.56%. It's going to be lower or higher? How much lower? How would I compute how much lower? It's 17.56 over 100 right now, right? What did I just say is going to happen to the denominator? It's going to become 130. You take 17.56 divided by 130, there's your return equity of 13.5%. 13.5% return equity multiplied by that retention ratio is going to give you a growth rate of 5 or 5.5%. You can already see that even if banks return to health, the growth rates are going to be able to deliver are going to be far lower because they will be required to set aside more capital to generate the same net income. And the way it's going to manifest itself is the return equity looking forward, even at healthy banks, and Wells Fargo is probably one of the healthiest large banks out there, is going to be closer to 13 or 14%. But you don't have to guess. Just take the return equity they used to have, make your judgment on how much the book equity will have to increase, or the capital ratios are going to change. And that's a judgment. You can read up as much as you want on it. But ultimately, that's the way it's going to manifest itself in the growth rate, as a lower return equity and a lower growth rate. Any questions on retention ratio, return equity? Okay? Yes? They might, in a sense, that's what's going to feel. So if that changes as well, then maybe the growth rate will. But here's the problem. Banks have a problem, or they want to pay the same dividends as they used to. So they will have to make the decision. Will they retain more, in which case they might be able to maintain that same growth rate they did before, but then you'd have to have lower dividends. So if you're valuing Wells Fargo, you either keep the dividends fixed and lower the growth rate, or you drop the dividends and keep the growth rate. You will not be able to have your cake and eat it too. You will not be able to show the dividends they used to and have the growth rate of 8%. So you'll have to make a decision as to which path they're going to follow. And given how stubborn banks are about cutting dividends, I wouldn't be as quick to decide that they will, retain more. Issue shares? Or issue shares? And that's the problem. This is what I think will happen. They will continue to pay the dividends they used to. They will issue shares through the other door to raise the equity. It's kind of a silly thing to do. Right? You think, why don't you? But this is what happens when you start paying dividends. This is one of the things we talked about with dividend policy. It's sticky. Once you start doing it, it's very difficult to step back from the precipice. I mean, I'll agree with you that they should cut dividends, but if they don't cut dividends, then basically you're going to see shares start to be issued to cover the capital, which in turn is going to affect the growth rate and the value per share. Yes, Malik?
What about debt? For example, you're
Debt is not part of capital. When you do capital ratios in a bank, it has to be equity capital, right?
No, I'm just I'm asking a more general question about the retention ratio. So you're assuming that you basically take whatever you pile back and that's your driver for growth.
Okay.
But
I see. Okay, that's a good question. The question that Malik is asking is, maybe you're not retaining very much, but if you can borrow enough, you could still deliver a pretty good growth rate, which is another way of saying there are two ways of delivering a high return equity. One is by taking great investments. The other is by using leverage, as you told. In fact, let's turn to that leverage aspect, because that's what I was going to talk about next. If you decompose the return on equity for a company, there are two pieces to the return equity. One comes from the quality of your projects, return that you're making by actually the 10% you're making by investing in a project. But the second term there captures the effect of leverage. Here's what I'm going to ask you. How much are you borrowing for every dollar of equity? Okay, that's your debt to equity ratio. Then I'm going to ask you, what are you paying as your cost of debt? So as an example, if you're able to borrow money at 4% and take projects that make 10%, guess who gets a 6% difference? You as the equity investor walk away with that difference. This is why companies like to borrow money, right? It kind of pumps up their returns on the upside. But let me ask you a follow-up question. You have two companies that both deliver a 20% return on equity. The first company delivers the 20% return on equity by taking great projects. It uses no debt. The second company delivers a 20% return on equity by borrowing a ton of money and pumping up those 10% projects to have a 20% return on equity. Which one would you value more highly? The good projects. And how do we show that in evaluation? Intuitively, we agree. Where in our valuation do we punish the second company? When we do the cost of equity for the second company, it'll reflect the fact that you use debt. So in a sense, this is another one of those mixed blessings. If you put your foot to the leverage lever and push up your return equity, I will give you a higher growth rate. I'm not going to hold back on that. But when I do your cost of equity, I'm going to say, hey, you used a lot of debt. Your cost of equity is 15%, not 10%. So you can pump up your return equity by using debt. And the key here is because the after-tax cost of debt is so much lower than the return you're making on your projects, you're keeping the difference. But it's a double-edged sword, right? For this to work, your return on capital has to be greater than your after-tax. That's a minimalist requirement. But if that condition is not met, then leverage can actually push your return on equity in the wrong direction. Alpa? Lower than what?
Lower than the weighted average cost of capital for the company.
Oh, it has to be, right? No, don't jump to that conclusion. The cost of debt will always be lower than the cost of capital. But it doesn't follow that using debt is going to make you a more valuable company, because when you use debt, you change both your cost of debt and your cost of equity. It's not just a question of replacing more expensive equity with cheaper debt. You're altering both numbers by borrowing money. And that effect could overwhelm whatever benefit you get. That's why when you do, initially debt might help you, but at some stage you're going to start seeing it become counterproductive. So when you look at the return equity of a company, try to take it apart. In fact, I'm going to take two companies so you can see the kind of extreme scenarios that can play out here. One is an example that's so old that the company's changed its name. Company, it used to be called Brahma, it's now called Ambev. Very well-run beverage company in Latin America. This is in the late 90s. I took a look at their return equity, and I decomposed it. And at the time that I looked at them, they had a return on capital of about 20%. That's pretty good, right? They had a debt to equity ratio of 77%. So they were borrowing enough money to kind of even push up that. And their after-tax cost of debt was 5.6%. So think in intuitive terms. For every dollar that you borrow, you're making that difference between 19.9 and 5.6%, and you're putting it into the equity investor's pocket. So not surprising, when I do my return equity, I start with the 19.91%. That would have been the return on equity. They'd use zero debt. And on top of that, they added another 10% because they've used debt, and the cost of debt is so much lower than the return on capital. So in good times especially, if you get focused on return on equity, as we often do, companies can play this game to the hilt, right? Real estate companies do it all the time. Banks, if you think about it, push up their return equity by pushing up the leverage. And when times are good, you don't notice the risk because all you see is that great return on equity. It's only when the return on capital on projects start dropping in a recession that you realize all of a sudden the dangers of borrowing this much money. It starts to come back to bite you. But that minimalist condition has to hold. The return you make on your projects has to be greater than the after-tax cost of debt that you have on your borrowing. But 5 or 6 years ago, I went back on a trip to India. I go back about once a year to visit my parents, and whenever I go for like 4 or 5 days because that's I get bored after that and I have to leave. So But usually when I go, my relatives use this as their opportunity to view me as a consultant, a free consultant, of course. And so about 5 or 6 years ago, I go back, my uncle calls me and he says, you know what, we need some help. And I said, what do you need? And he said, he was actually the chairman of a company called Titan Watches, which is actually a fairly well-regarded Indian watch company. He said, at Titan Watches, we've been borrowing money because we've heard that borrowing money pushes up the return equity. But every time we borrow money, our return on equity seems to go down. Would you come in and take a look at the numbers? So I came in and took a look at the numbers, and I was surprised that they hadn't looked at the numbers themselves. First, I computed the return on capital, 9.5%, not bad, right? And remember, this is India in 1998. The borrowing rates are 15, 16%. Their after-tax cost of debt was 10.125%. We're already in the hole, right? You don't even have to do any of the math to recognize what's going to happen as you borrow money. Every time you borrow money, you're paying 10.1% on the extra dollar of borrowing. You're investing in a project making 9.6%. It doesn't require mathematical genius to figure out that if you keep pumping up debt, your return on equity is going to go in the wrong direction. It's a minimalist condition, but sometimes people forget that condition. If you're borrowing money at sky-high rates, you're investing it in projects that earn less than that after-tax cost of debt. And God help you, you start losing the tax benefit. Because then the cost of debt shoots up even more. Then you're going to get squeezed because that debt, instead of helping you, is going to start hurting you. So try that for your company. Take the return equity. Return equity is net income divided by book equity. Compute that number. Then try to break it up. How much of that is coming from taking good projects? How much of that is coming from leverage? Because that leverage part is the dangerous part. It's the part that can hurt you if things are not going well. Okay? So that's the first growth rate, is a growth in earnings per share, retention ratio times return equity. Let's move up the ladder. Let's talk about growth in net income as opposed to earnings per share. You think, shouldn't it be the same? Not quite, because there are ways of growing net income which might actually not show up as a per share growth rate. To look at growth in net income, I'm going to again go back and define reinvestment rate and return on investment. I'm going to do that with every measure of growth. When I look at net income growth, rather than look at retention ratio, which is actually a very lazy way of computing reinvestment. Do you see why it's lazy? Because whatever you don't pay as dividends, I'm assuming you're reinvesting in the company. But are you reinvesting everything in the company? When you don't pay out something as dividends, is it automatically reinvested in the company? What are the two places it can go? It can go into projects, or it can sit in a cash balance, right? I'm not distinguishing between what you're doing. I'm just saying you're not paying it out as dividends. You must be reinvesting it. So when I talk about net income, I'm going to be more specific about the reinvestment rate. I'm going to look at how much of my net income I'm actually putting into projects. And I know how I can measure that, right? I can look at the net capex and the change in working capital. And since I'm looking at just the equity portion of that, I'm going to multiply that reinvestment by 1 minus the debt ratio. It's what we did with the free cash flow equity computation. We're looking at how much equity is being reinvested back in the business, rather than assuming that everything that is retained is reinvested. That's called an equity reinvestment rate. It's a portion of your net income that's kept in the business in the form of reinvestment in equity. Now let's think about the difference between this number and the retention ratio. What's the highest value retention ratio can take again? 100%. What's the lowest value retention ratio can take? 0%. Let's think about the equity reinvestment rate. Is there a cap on the equity reinvestment rate? In other words, can the equity reinvestment rate be greater than 100%? Sure, right? It's net capex, change in working capital. If I do a lot of acquisitions, make a lot of investments, I could have a huge net capex relative to my net income. You know what that's telling you, right? If the equity reinvestment rate is greater than 100%, what are you doing? You're issuing shares to cover the difference. Basically, here I'm allowing for the fact that since it's not a per share number, you can increase your net income by issuing shares like crazy and grow your business. So the equity reinvestment rate can be greater than 100%. That makes it different from retention ratio. Can it be less than 0%? I know dividends cannot be less than 0%, and retention ratio cannot be less than 0%. But can an equity reinvestment rate be less than 0%? What goes in the numerator? Net capex and change in working capital, right? Can net capex be negative? Sure. In any particular year, depreciation can be greater than capex. Working capital changes can be negative. So equity reinvestment rates can be negative, which means you're shrinking your business. So again, we're opening the possibility up because we're looking at net income and how much is actually reinvested. So equity reinvestment rates are not capped at 100 or floored at 0. They can be greater than 100% or a negative number. So that makes it different. I'm still going to measure how well you invest with your return on equity, because I'm still looking at equity earnings. So the big difference between going from earnings per share growth to net income growth is I've replaced that retention ratio number, that sloppy measure of reinvestment, with a much more specific measure of reinvestment. And your growth in net income is going to be the equity reinvestment rate times the return on equity. So when we talk about growth in net income, we're talking about a very different number than growth in earnings per share. There are companies that register great growth in net income, but if you look at the per share numbers, they're not going to be great because they're issuing shares to grow. And that's what we're bringing in through that equity reinvestment rate. Okay. So that's the second measure. So we've gone from earnings per share to net income, both equity measures. Let's move up the ladder to operating income. By now, you probably get the pattern. When I asked you how much do you reinvest, you always define it in terms of whether you're looking at equity or the entire firm. Now we're looking at operating income and ask you how much you're reinvesting. What's your reinvestment rate? Here I'm going to measure how much you reinvest by looking at net capex and change in working capital, just as I did before. But now I'm looking at the total amount because we're now looking at the entire operating income of the entire business. And instead of dividing by the net income, I'm going to divide by after-tax operating income. It's almost we're staying within each system, right? When we're talking about free cash flow to the firm, we start with after-tax operating income. Now we scale how much you reinvest to the after-tax operating income. That's called the reinvestment rate. Reinvestment rate, like the equity reinvestment rate, is not capped at 100, not floated to 0. It can be well above 100%. Some of you will find for your companies, especially if they've done acquisitions and grown a lot, that your reinvestment rate can be well above 100%. Some of you, it can be below 0%. But the reinvestment rate measures how much of after-tax operating income is put back into the business. Now let's ask the other half of the question. How well are you reinvesting? With equity earnings, the way I measured it was, how much are you making on your equity, right? Here I'm looking at the entire firm. So when I look at the entire firm, the return I'm going to be focusing on is not return on equity, but return on overall capital. So to get that, I'm going to look at how much operating income I have, net of taxes, divided by the book value of debt and equity. So net income is net income divided by book equity. Return on capital is after-tax operating income divided by the book value of all capital. Actually, this is the only place in finance where we use book values. Notice that everywhere else in finance, we're kind of fanatical about market value debt ratios, debt to equity ratios. We get to return on equity and return on capital. It's the only place in finance where we stick with book values. Why is that? Why do we stay with book values when it comes to return on capital, but use market values everywhere else? Yes, Malik. In other words, what's the question you're trying to answer? You invested some money in projects. Did you make a good investment, right? So let's take an example. 4 years ago, you invested $80 million in a project. You're making $40 million a year in profits right now on that project. Was it a good investment? Absolutely, right? Because you invested only $80 million, you're making a $40 million profit. That's a 50% return. If I mark things up to market, you know what's going to happen, right? That $80 million marked up to market is going to be worth $250 million. In other words, once I start marking up to market, all projects should be earning their cost of capital. That's the definition of marking up to market. I am missing then the quality of my investments. This is precisely why fair value accounting is going to get us into trouble. Because if it stays true to its mission, what should happen? Every asset on the balance sheet should get marked up to market. Every company should earn its cost of capital. How the hell am I going to distinguish between good companies and bad companies, assuming you do your job? This is assuming fair value accounting actually delivers its promise. I don't think they will, but if they did, we'd be in big trouble. Because we'd have no way of distinguishing between good companies and bad companies. The reason we focus on book capital is we want to look at the capital actually invested in projects and what that capital is earning. Market value is two problems. One is marked up, right? So it reflects, we have good projects, the market value will go up to reflect that. The second is also includes growth assets, investments I expect you to make in the future. By definition, those investments are not delivering earnings right now. It's unfair to put into your denominator the market value of equity and say, hey, deliver a return on that if those investments haven't even been considered yet, haven't even been thought about yet. So the reason we use book value for return on equity and return on capital is very simple. We're trying to answer a very specific question. You made investments already. Were those investments good investments or bad investments? Then we extrapolate from there. If you this is a big number now in finance. Wherever you go to work, you're going to see this ROIC, ROC discussion constantly swirling around you. What should we add? What should we subtract out? There are entire outfits that just do this, compute return on capital for firms. If you're interested in the topic, I'll send you a link. I have a paper on all the items that throw off the return on capital calculation. I'll give you an example. Goodwill, nightmare when it comes to return on capital. Should we exclude it? Should we include it? Okay. What about leases? The problem on the quiz, how do they affect return on capital? R&D, how do they affect return on capital? The reason we care about this is not because we want to get return on capital for last year, but because that becomes the basis for our forecast into the future. Our growth rate in operating income is going to be a product of your reinvestment rate and the return on capital. We talk about quality of growth all the time. You know how you measure the quality of growth? How much do you reinvest to deliver that growth? The less you reinvest to deliver a given growth rate, the higher the quality of the growth. Anybody can deliver 10% growth if I allow them to pump as much money as they can into the business. So the way you reward companies for having high quality growth is you let them have a lower reinvestment rate for any given growth rate, which means they deliver higher cash flows to their investors while they deliver the growth rate. In fact, to show you how different companies can be, I'm going to take you through two companies that I looked at again several years back, 99. Okay? I'll give you an update on both companies. I looked at Cisco and Motorola, both technology companies. But in 99, when I looked at Cisco, its reinvestment rate was 107%. That's pretty impressive, right? But they did a lot of acquisitions. I'm counting that as part of reinvestment. But what was even more impressive was if you looked at the return on capital in 99, they earned a 34% return on capital. They were pulling off one of the most difficult tasks, I think, of running a business, reinvesting a lot and reinvesting well at the same time. And they had pulled this off every year from 91 through 99. And you know how it showed up, right? Market cap for Cisco in 91 was $4 billion. For a brief period in 1999, Cisco was the most valuable company in the world, more than $400 billion. That's how you go from a $4 billion to a $400 billion company, is for year after year they kept pushing both ends of the spectrum, reinvesting a lot and reinvesting a lot. But there's no secret there. The way they were able to do it is they were able to do acquisitions, turn those companies, commercialize the products, get them out of the door, deliver earnings. Motorola, on the other hand, in 99 had a reinvestment rate of 53%, not bad, and a return on capital of 12%, not bad. But not bad times not bad gives you not bad. Right? Look at the growth rate. The growth rate is about 6.5%, nothing to complain about, but nothing to boast about. You can, if I put you in charge of Motorola and said, can you deliver a 15% growth rate? Your answer will depend on, can I change the reinvestment rate into the return on capital? If those numbers are kind of set by the outside competition, you're kind of stuck. You can't set unrealistic expectations for your growth rate. If you do, you're going to push the envelope, you're going to make mistakes. You're going to do what AT&T did, which is they set the growth rate target first, and then they looked inside to see how do we deliver that growth. That's a terrible way to run a business, because that's how you get accounting scandals. That's how you do acquisitions and you try to hide the cost of the acquisition. You might be able to cosmetically deliver that growth rate, but look at your fundamentals. Your fundamentals will already tell you what a realistic growth rate is for your company, and live within that realistic growth rate, because you really can't deliver a 20% growth if your return on capital is only 10% and you can reinvest only 60% of your earnings. In fact, let me test you out. We talk about quality growth all the time. I'm going to show you 5 companies. In a minute, I'll come to that. But before I do that, though, let me bring in the effect of efficiency growth. There is one small out in this process where I say if you have a low return on capital, you can't deliver growth, and here's what it is. If you can improve the return on capital on existing assets, you get a short-term burst in growth. Let me take a very simple example. Let's assume you have a company with a 5% return on capital. Terrible company. You're hired as CEO. The company has no new projects, so the reinvestment rate is 0. Right? You're saying, I'm sunk. There's nothing I can do. But he said, maybe on these existing projects, I can improve the return on capital from 5% to 10%. So I'm not asking for miracles. Just make your cost of capital, right? So if your return on capital goes from 5% to 10%, if you're able to pull that off, what's your growth rate going to be in the year that happens? You used to make $5 of income. Now you're making 10. That's a 100% growth rate, right? In fact, mathematically, the way you can compute efficiency growth is you take the change in the return on capital. 10 minus 5% is 5%. and divide by the return on capital, which in this case was 5%, that gives you a 100% growth rate. You're saying, this is great. Why am I even making new investments? What's the catch, though? You get a 100% growth rate next year. The year after, though, you want to say, it's gone. It's going to be short-term growth, but I'll take short-term 100% growth over no growth at all. So when we talk about efficiency growth, we're talking about the second component, improving returns on capital in existing assets. And the way it shows up is as a higher growth rate, at least in the years that you can do it. In fact, when I was valuing Motorola in 99, I looked at that 6% growth rate. And I thought it was a little unfair that the growth rate was low. But I couldn't arbitrarily change the return on capital or the reinvestment rate. I took a look at the sector that Motorola belonged to. And in 99, the return on capital in that sector was about 21%, 22%. So I took that 12% return on capital and I made an assumption. You might disagree with this assumption or agree with it. I said over the next 5 years, they can improve their return on capital from 12 to 17%. So two things are going to happen here. One is they're going to continue to make new investments and earn a return on capital of those investments. The second thing that's going to happen is their existing assets, they're going to improve the return on capital from 12 to 17% gradually over the next 5 years. I don't think it'll happen in 1 year, but over the next 5 years. So in fact, there are two ways they're going to be able to deliver growth. The first is the new investments they take. Those new investments, I assumed you could immediately jump to 17% because you're starting afresh. So 17% times 53%, which is a reinvestment rate, gives me a growth rate of about 9%. So if they did nothing else but those new investments, they'd have a growth rate of 9%. The second term here, which looks kind of mysterious, is the 5% improvement in return on capital. As a percentage of the 12%, that's about a 40% growth rate, but that's spread out over the next 5 years. Now, if you don't like the algebra, if it looks too complicated, just take 40 divided by 5, that's about 8% a year. I try to get a little fancier. I said because it's compounded, I'm going to take the fifth root of that. Okay, so all I'm doing is spreading the 40% out over time, because if you really grow 8% every year for the next 5 years, you actually grow more than 40%. So in this case, if you look at the total growth rate for the company, there's 9.12% coming from new investments. The remaining growth is coming from efficiency. But here's the difference. At the end of the fifth year, the efficiency growth will be done. Then I have to look entirely for new investments to grow. There will be no more efficiency growth. I'm going to have to kind of grow by finding new projects and making sure those projects deliver returns. Those of you valuing companies that are mature companies in decline, terrible returns on capital, before you start pumping up the reinvestment rate, ask yourself a question. This is a mature company. Where is it going to find all these investments? I mean, you can put in an 80% reinvestment rate into my spreadsheet and a 25% return on capital. It's still computed, but it's not feasible. The way these companies will be able to deliver growth is by improving their return on capital. And your best case scenario from a valuation perspective is your company is earning well below its cost of capital. Do you see why that's a best case scenario? Because you don't even have to assume they have to do anything other than earn their cost of capital. They don't even have to make excess returns. If they can climb back up to their return on capital, they're going to get a big bump in growth rate in the period that they have to do that. But if you have a company that's already making 30%, don't assume efficiency growth. Because if you're already at 30, where are you going to go? 35, 40, 45, that's unrealistic. So here's my question for you. I'm going to show you 5 companies, all of which have the same bottom line growth. Analysts love to point to bottom line growth, right? Look at the growth rate, 10%. They all have 10% growth. But they all got there with different pathways. The first company got there by reinvesting in new projects and earning a 20% return. 50% return on capital, 20% reinvestment rate. So 50% times 20% is 10%, no efficiency growth. The second company got there by reinvesting 100% at a 10% return on capital. Still the same growth rate, 10%, no efficiency growth. The third company got there by reinvesting 200% and earning 5% of that. Still a 10% growth rate. The last 2 companies, in addition to having new investments, also had some efficiency growth. In fact, the fifth company reinvested nothing, but was able to improve its return on capital from 10 to 11%. That's a 10% growth rate. So they all have the same growth rate, and you're an investor looking at the 5 companies. What I'd like you to do is rank these companies from a value perspective, from the company that you would think would be most valuable to the company that would be least valuable. Let's start with the easy one. Which is going to be the least valuable company of the mix? They all have 10% growth rates, but one of these companies actually is killing you while it's growing. Which one is that? Look at company 3. It's growing, right? But how is it growing? It's doing the Starbucks growth. It's growing, but it's reinvesting at 5%. Your cost of capital is 10%. You're growing, but you're actually devastating value as you grow, because every time you grow, you're taking away some value. So the company that's at the very bottom of the list, in fact, not just least valuable growth, negative value to growth will be company 3. What's the company just above it? Company 2, and what's it doing? It's a blah company. It does no good, it does no bad. Basically, it just stays in place, right? Because if you grow and you earn your cost of capital, in effect, you're creating no value, you're destroying no value. So at least we're glad it's not company 3. But it's a little further up the ladder. Now we come to the trickier choices. Which one of the companies are you going to put at the very top of the list? If you just look at 1-year growth, which one delivered almost free growth for you? Company 5, right? They reinvested nothing, and they were able to. But the problem, though, is this is a 1-year deal, right? Next year, they'll have to go from 11 to 12.2. The year after that, they'll have to go from. So you can already see that it's finite growth. But for that 1 year, it is very valuable growth, but it's going to be tapering off. So it was nice when it lasted, but it's not going to last that long. So you're really looking between firm 1 and firm 4. Firm 1, if you think in terms of long-term growth. So there are two things you're looking at. How efficiently is the growth being delivered? And for that, you can look at the reinvestment rate, right? That basically is the measure that matters. How sustainable is that growth? And for that, you're looking at, is it coming from efficiency or is it coming from new investment? If you bring both dimensions in, I would put company 1 on top of the list, even though they have exactly the same growth rate as the others. Because even though the reinvestment is higher than company 5, it's sustainable growth. They have great investments. They're earning at 20. In this case, the return on capital they're earning is the return on capital that can keep delivering this growth for an extended period. So what I'm trying to say is, when you look at your company, you look across companies, and you'll do this when we do relative valuation. We'll rank companies. We'll look at all of the same growth rate. Look beyond the growth rate. Look at the reinvestment rate. Look at where the growth is coming from, because that's what's going to determine which of these companies has value and which doesn't. Last set of characters. So far, we've started with earnings and return on capital and built on that. And that works fine if your company's margins are in steady state. You know what I mean by steady state? You feel they've hit a level that they could sustain forever. If you're valuing a company where margins are evolving, they're changing over time. It might be even negative right now. You can no longer start with operating income and keep going. You've got to go up the ladder to revenues. I try to avoid doing revenues unless I have to, but if margins are changing, you have no choice. So here's the sequence. You're first going to project out revenues for the future. Some revenue growth rate. For that, you can look at the potential market share. We'll talk about a couple of tactics you can use to get the revenue numbers. Second step in the process, you're going to project the margins you're going to have over time. You know, how the heck would I do that? You know where you are right now. You've got to pick a target. You pick a target by looking at other companies in the sector, the company's own history, and say, this is where I expect to be. When you have to have a vision of what your company will look like once it gets past this early stage. So you'll have margins changing over time. So your revenues are growing, your margins are changing, you're going to get operating income. But is it easy to grow revenues? And we talked about reinvesting to generate operating income, right? Do we have to reinvest to generate revenues as well? Sure, revenues are not going to happen by themselves. This is one of the trickiest parts, is coming up with how much you want to reinvest or need to reinvest to sustain that revenue growth. I use a ratio called the sales to capital ratio. It's a very unusual ratio. Basically, it looks at, in its sector, how much revenue you get for every additional dollar you invest. So if you get a sales to capital ratio of 2, for every dollar of capital you invest, you get $2 of revenues. I'm going to use that to kind of back out how much I will need to reinvest to get the revenues each year. And then I'm going to tie up the loose ends to make sure I've reinvested enough over my lifetime, over the firm's lifetime, for it to be a sustainable company. Okay? I'll set up the company. We won't have time to do the whole thing, and then we'll come back and talk about this in more detail. The company I valued is a company that's still in the news right now. Okay? Sirius. It's in the news for all the wrong reasons. Right? This was right after they signed that really big contract with the other Stern. A lot of people in New York would think this school is named after him. You know, maybe it won't be such a bad idea. The Howard Stern School of Business would be the entertainment school. So I was valuing Sirius, and at the time that I valued them, they had $187 million in revenues, and they were losing $787 million. Clearly not steady state. At least you hope and pray it's not steady state, right? Because if this is your steady state, we're in big trouble. Their operating margin is minus 420%. For every dollar in revenues, they're losing $4. You know, how the hell do you do this? Well, you sign how many million? A $200 million contract with Howard Stern. You build infrastructure, and then you go looking for revenues. This is exactly what's going to happen. So I said, I'm going to sit down and value Sirius. I can't assume margins are stable, so I'm going to start with revenue. So I start with $187 million, and I projected out revenues for the next 10 years. I'll be quite honest. I didn't actually do it year by year. I looked at the end year, and I made a judgment of where Sirius would fall by year 10. I looked at Clear Channel, which is the largest, most mature company in this sector. I looked at their revenues, and I said, how much revenues do I think Sirius will have in year 10 relative to Clear Channel? Because there's nothing inside the company I can look at for what's reasonable. So that's how I got the end number. And once I got the end number, I kind of backed into the middle numbers with a very simple proposition, which is the growth rates in the early years are going to be higher because you have smaller revenues. As I go through time, they've got to become smaller. You know what? If you have issues with the intermediate growth rates, I will concede to you whatever number you want. Because if you give me the starting number and the ending number, you've given me the valuation. This is part of the reason with growth companies. Don't get too focused on getting revenues in year 3, revenues in year 4. Those are not the numbers that will drive your valuation. It's at end market share that you think, end revenues, the target revenues that are going to drive the process. So that's basically that's a starting point for the process. Last thing and we're done. Tomorrow, Monday when we start off, we will start with the margins. I'm going to talk about how I push the margins up, and we'll talk about tying the last loose end. But I'll see you on Monday.